Hi, everyone. Marc Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. Today, I'm answering a question from a viewer, and he writes, WTF. Sorry, that's WETF. He wants to know about ETFs and if I recommend them. So first of all, if you're unfamiliar with ETFs, they are a lot like mutual funds, except they trade a little bit differently. A mutual fund, you can buy and sell at the price you get is the value of the fund at the end of the day. So no matter what time you place your order, you get filled at the price at the end of the day. An ETF trades all day long on a stock exchange. So if you place your order at 11:15, you get filled at the price at 11:15, which will be different than at 11:20. And you can actually actively trade ETFs all day long as well, if that's what you're into. Now, for ETF investors, there are a lot to choose from. At the end of last year, there were 2,096 ETFs out there versus 6,100 stocks. So that's a lot of ETFs chasing not that many stocks. I mean, it's less than 3 stocks for every 1 ETF for those of you keeping score at home. Some of the most well-known ETFs cover broad indices, such as the Spider S&P 500 ETF, and that symbol is SPY, and that tracks the S&P 500. So when you purchase that ETF, you are getting the same performance as the S&P 500 minus a tiny expense fee. And there are ETFs for pretty much every sector and subsector. So if you want exposure to the biotech sector, for example, you could buy the iShares NASDAQ Biotech, symbol is IBB. You can invest in gold through the Spider Gold Trust, symbol GLD. Bullish on airlines, but you don't want to invest in just a couple of airline stocks, consider the US Global Jets ETF, symbol JETS, 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 Jets. That's for you, Rob G, and all my New Yorkers. Now, do you have more eclectic tastes in your investment themes? There is something for everyone in ETF land. There's an ETF that follows market volatility, so not the direction of the stock market, but how volatile these stocks are. That ETF is the iPath Series S&P 500 VIX short-term futures, symbol VXX, and that's actually something I trade quite a bit. Is fertilizer more your thing? Check out the Global X Fertilizers Potash ETF, symbol SOIL, or soil. See what they did there? There are 68 individual country ETFs that invest only in the stocks from one single country. So you could buy stocks from just Denmark or Egypt or Russia, for example. Now, when you buy an ETF, it's important to see how the portfolio is constructed. And you can do that very easily. Anytime you're researching an ETF, there should be a link that says holdings, and that will show you at least the top 10 holdings in the portfolio. And it's important because they're not usually equally weighted. And what I mean by that is if an ETF's portfolio holds 20 stocks, usually it's not going to be 5% allocated to each stock evenly. So you want to see how heavily weighted it is to each individual stock in case that's important to you. For example, if you wanted exposure to biotech, we mentioned the IBB before. Now, 9% of that portfolio is invested in Gilead Sciences, another 9% in Amgen, 8% in Vertex Pharmaceuticals, and 7% in Regeneron. So in that portfolio, 1/3 of the entire portfolio is invested in just 4 stocks. So that's important to note. Now, a question I get all the time is, Mark, should I invest in individual stocks or am I better off in ETFs? Well, like all things in investing, that depends. Okay, thanks for watching, and I hope you'll like and subscribe. No, I'm kidding. I will answer the question. If you're an investor that wants to set up a diversified portfolio and more or less set it and forget it, you might have to rebalance it, but really a very hands-off approach, ETFs are a good way to go. You can create your portfolio with about a half a dozen or more ETFs that can cover a wide variety of asset classes, including stocks, fixed income, and commodities. However, you'll probably never beat the market with ETFs because essentially ETFs are the market. They track an index, so you'll always be right around the performance of those indexes. To beat the market, you'll probably need individual stocks. Now, the question I get most about ETFs relates to dividend aristocrats and perpetual dividend raisers. And these are the companies that raise their dividend every year. And I talk a lot about these types of stocks in the previous 2 videos that I made. So if you're interested, definitely check those out. Now, there are a few ETFs that invest in these types of stocks, such as the ProShares S&P 500 Dividend Aristocrats ETF, symbol NOBL. However, and this is a big however, these ETFs usually do not have steady and rising dividends, which is the exact reason you want to be invested in these types of companies. You can see from this chart the dividend for NOBL is all over the place. It's up one quarter, down the next. When you invest in dividend aristocrats or perpetual dividend raisers, you're trying to capture those consistent dividends that go up every single year. And these ETFs do not deliver that, even though they invest in these companies. So this ETF also has a yield of about 2.2%, so not too impressive. Compare that to one of my favorite perpetual dividend raisers in the biopharma space, AbbVie, symbol ABBV. This company yields 5.3% and has raised its dividend every single year since 2013. So to recap, ETFs are a great way to create an inexpensive, diversified portfolio or to invest in an index of unique sectors or countries like fertilizer in Egypt. But to beat the market, you're probably going to need individual stocks, and I especially like individual stocks when it comes to perpetual dividend raisers. Now, I write about dividend stocks and all things investment related in my free newsletter, Wealthy Retirement, so click the link below to subscribe. Until next week, I'm Marc Lichtenfeld. Thanks for watching State of the Market.